A cost segregation study breaks the property down into all these different components, puts a value to those components so you can write them off in most cases now in year one. And so you're getting this bigger tax deduction than you normally would have. It's really a time value of money play, right? Instead of taking those deductions over a long period, let's take them now. Let's use that tax savings to reinvest into more properties.
Welcome to the Freedom Point Podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in.
Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer.
All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into yet another episode of the Freedom Point. I'm so glad you're here with us again today. I've got another amazing guest with an amazing topic. Before I go to the topic, however, let's welcome Gian Pazzia. Gian, welcome to the show.
Thank you so much. I'm excited to be here.
Likewise, looking forward to chopping it up with you. So Gian helps companies, real estate owners, and CPAs unlock proven tax strategies and incentives created by Congress so they can invest in growth. Gian, really what we're here to talk about is cost segregation study, bonus depreciation, passive loss activity, tax incentives, those types of things. But before we really unpack, cost segregation, as a strategy for both active and passive real estate owners, I'd love for you to tell us a little bit more about, your own personal background, your journey, and what you're currently focused on today.
Yeah, thank you, Jeremy. So I grew up in Boston, son of two immigrants. My both my parents, born in Italy, came on the boat in the 70s, landed in Boston, met each other. My dad had a pizza shop. My mom was a hairdresser, so definitely lower middle class. And I grew up where money was tight, and I think just learning the value of saving, and not, kind of freely spending money. But my dad got involved with real estate investing, kind of, later in his life when he realized, he couldn't just keep working. He always had that mentality of saving and investing, right? And so kind of being there and seeing what he did kind of set me up for the future. And so, I ended up going to school at Purdue as an engineer, great engineering school there. Um, Ended up realizing I didn't want to be an engineer by the time I graduated, and I ended up finding a job at Arthur Anderson, which at the time was one of the biggest CPA accounting firms in the world. And they were looking specifically for construction engineers like me, that could help their clients depreciate their buildings faster. So they were doing, cost segregation's actually been around a long time, really going back 50 years. But when I was graduating college, it was really only a few of the major CPA firms that were doing it for these massive clients like casinos, the Caesar's Palace and Bellagio, major pharmaceutical manufacturing facilities, et cetera. And so that's where I cut my teeth. I learned how to do cost segregation over 25 years ago. And, I got lucky because I ended up meeting a group of guys here in California, where I'm based now, that wanted to start a cost seg practice, and they needed somebody with my skill set. This was at a time where it just wasn't quite as mainstream as it is now. And we were one of the first firms that, you know, outside of those big accounting firms to offer this service to the smaller investors. And we've grown since then.
Yeah, that's great. I appreciate that background. And also to learn now that you also have no rich uncles, you had a father, that kind of had that mentality or mindset of being the rich dad versus the poor dad. And then of course you were able to take your background, in schooling and engineering and really apply that, into the cost segregation space, which is, I guess, by definition, some form of engineering, and maybe you can unpack that a little bit more for our listening audience and let us know why, why is it that when a sponsor or a cost seg firm, moves forward with performing a cost segregation study on a piece of real estate, why is it that it's being called an engineering type of a role or a function, or a strategy?
Yeah, look, let me kind of dive into kind of what cost seg is, and then I can answer that question. And really, cost segregation allows real estate investors to speed up how fast they're going to write off parts of their building. And so normally the tax code allows you to write off the building over 27 or 39 years, really slowly, right? But not everything in the building lasts that long. And so that's kind of the premise of why the tax code allows you to take shorter depreciable lives on certain components. And so we're talking about things like the vinyl plank flooring in a residential rental unit, things like ceiling fans, appliances, the piping and electrical that service those appliances, um, things like asphalt paving outside of the building. All of these things can be segregated and written off quicker. And so a cost segregation study breaks the property down into all these different components, puts a value to those components so you can write them off in most cases now in year one. Okay. And so you're getting this bigger tax deduction than you normally would have. And it's really a time value of money play, right? You're instead of taking those deductions over a long period, let's take them now. Let's use that tax savings to reinvest into more properties. Um, and so just to kind of put some numbers to it, Jeremy, let's say you buy a $300,000 single family rental unit. Now, the first thing you're supposed to do is separate the land value from the building value. Okay. And so in my example, let's just assume that the land is worth $30,000 and now the improvements are worth $270,000. You're supposed to depreciate that over 27 plus years. Okay. So you would get a $10,000 tax deduction each year for 27 years. Okay. 270,000. Now, if you do a cost segregation study, we're going to go in, we're going to identify as much as 25% of that building basis and call it a short life property, which now can be written off in year one. So now we're talking about $54,000 of write-offs in year one versus that 10,000 without the cost seg study. Now we're looking at $44,000 of extra deductions. And so that's really what this is all about. It's accelerating the deductions. And to bring it back to your question about engineers, so yeah, we have to go in there, and in order to quantify all the different parts of the building, it's going to require things like, counting and measuring how much wiring, how many square feet of roof tiles there are. I mean, it's kind of like when you hire a contractor and they're doing an estimate of how much it's all going to cost. Well, we're using a lot of those same principles, but we're doing it kind of on the other side of things. So we're quantifying each component and everything that makes up it, and then we're understanding how much it costs for each of those components. So what you get is this very detailed, sometimes 1,000 different line items that make up, a building's construction costs breakdown. And so that's where the engineers are needed. You don't want accountants doing this because not only do you have to do everything I just said, but you have to then apply the tax law to it. And the tax law is actually more understanding the function and purpose and how it's installed to see whether it meets that criteria. And that's, you need that blend of engineering and understanding of all the different components and purpose to do this properly.
Yeah, that makes total sense, and I appreciate that background. I'm just going to use a really simple example and follow that up with a question. So, whether it's an industrial property, a medical office, it's a single family home, a small multi, or a 300 unit apartment community, let's just say, for example, you install a brand new refrigerator at some point during the investment hold period. So, I would presume that through the cost segregation study, you may have already received some depreciation on that appliance over the course of the investment hold period. But what happens if by year 3 we replace that old refrigeration unit or refrigerator unit with a brand new one? Does that clock really start all over again? And do you lose out on any of the depreciation that you received on the previous appliance?
Yeah, good question. So appliances are kind of an interesting one. They're kind of easy for people to quantify and keep track of. But let's say it was, you know, call it the carpeting, right? 5 years later, you need to replace the carpeting. The original carpeting, you paid $10,000 for it. Um, the way that works is if you've depreciated the carpet it for 3 years and you still have 2 years left of depreciation to write off, but in year 3 you decide to replace that carpet, immediately you get to write off whatever's left of depreciation on that old carpet. So if you're 5 years in on a $10,000 carpet, you might have 4,000 left. You get that immediate $4,000 deduction. And then let's say it costs 15,000 to replace with new carpet. Um, I don't want to confuse your listeners. Right now, the rules say that you get 100% bonus depreciation on all of the stuff that we're kind of talking about. And so you'll get to write off the entire new cost of the carpet right away, the 15,000.
Okay, that makes total sense. And this is why you need a cost segregation engineering firm to come in and do this for you, and why a traditional accountant or yourself is probably not going to be able to, do yourself much justice in this regard. But you mentioned bonus depreciation. So I think this is probably a good time, for us to unpack that a little bit further. As most that listen to this, podcast understand, the benefits of being able to leverage depreciation to help offset either passive income or active ordinary income if they qualify as a real estate professional. But I'd like for you to maybe talk to us a little bit more about, the big beautiful bill, that passed, sometime here in July. And maybe explain to us how significant of an impact, that is on real estate investors, and maybe how it generally applies to most of us.
Yeah, yeah. So July 4th, the big, beautiful bill was signed into law. And look, before bonus depreciation was in place, normally you had to depreciate most of these interior components over 5, 7, or 15 years. And so if we did a cost seg study when bonus depreciation was non-existent, I used $54,000 in that earlier example. Most of that, or all of that 54,000 that we can now write off right away, would have to be spread out over 5, 7, or 15 years. So you would only get, call it $10,000 in the first year, 10,000 in the second year, et cetera. And July 4th, they brought back what's called 100% bonus depreciation. What that means is anything with a tax life of 20 years or less fits into these categories. You just get to write it off all off in year one. There is no needing to keep track of these schedules and spread things out into the future, which is beautiful. Um, and so yeah, that was the biggest thing that impacts, not just real estate investors, but all companies, all asset intensive companies like manufacturers, people buying equipment, whether they're contractors, et cetera. Instead of having to spend $100,000 on a new tractor, under the old rules, yeah, you would have to spread that out over 5 years. Now they get to write it off right away. And so it's really designed to incentivize investment in our economy. And it's worked over the years since they brought it in 2001. And now it's permanent. So I think that's good because it gives a lot of companies certainty as to how it's going to work.
Yeah, absolutely. The IRS has a way of changing, tax laws in order to provide incentives for investors to invest in things that they want you to invest into, right? So I appreciate your unpacking that.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
I'd like to talk a little bit now about kind of what that actually means, for, your traditional passive investor, maybe your active investor that is or is not what we call a real estate professional, right? A lot of folks that are listening to this podcast may qualify as a real estate professional under those rules, but the majority probably don't, right? So if you're a typical investor and you're, investing in a small single family home, that has a cost segregation study performed annually on it, or you're a passive investor, looking to passively invest into a real estate syndication, what are kind of the differences between being able to utilize that depreciation in the year in which it's accrued, so to speak, versus not? Can you maybe talk to us a little bit more about kind of the pluses, the minuses, et cetera?
Yeah, sure. So normally if you meet this definition of a real estate professional in the tax code, it really unlocks a lot of kind of benefits. And your listeners may know that in order to meet that definition, you have to spend a significant amount of hours, 750 hours or more, really dealing with real estate, managing properties, et cetera. And it has to be, you can't be spending more than half your time in something else. Okay, so you can't be a doctor spending 1,000 hours running a medical practice and spend 750 hours doing real estate and meet the criteria because you're spending more than half your time as a doctor. And so, but if you do meet that definition, you can use your deductions, these accelerated deductions from cost segregation. You can create these losses, right? Paper losses, and you can use them against all your other income. So that's beautiful. Um, Passive investors, it's not the case, right? You're not allowed to take your depreciation losses from real estate and use them against your other non-passive income. And so, yeah, if you are a doctor, you have $1 million of income from your medical practice. If you create $500,000 of losses from real estate activity, you're not allowed to take those losses against your medical income. Okay, so sometimes if you're passive, you really need to look at, can I use these deductions? Is cost segregation going to make sense if I don't have much passive income from these properties? And so you'll want to really understand your tax situation if you're passive. But I will say, you know, that doctor may have 10 different properties, right? And he might have 5 of those properties that they bought 10 years ago. They're running out of depreciation on those. They're starting to spit off much better income. You're starting to produce that taxable income. You can absolutely use a cost segregation strategy to buy new property, get new depreciation to offset that other income from other properties. Um, Also, if you're selling one of those other properties and you're expecting a big capital gain, you might want to consider buying another property shortly after so you can create depreciation losses to offset capital gains that you're expecting in a certain year.
That makes total sense. And I think based upon what I'm hearing is that if you can qualify as a real estate professional, you or a spouse, you're able to leverage those passive paper losses, otherwise known as depreciation, to offset potentially active or ordinary income. Of course, we're not CPAs, so consult with your CPA on that. But for those individuals that cannot qualify as real estate professionals, like, for example, your example of a medical doctor, um, all benefit is not lost. It's just that they can only use passive paper depreciation loss activities to offset passive income in other passive income type related investments. And if they don't have enough passive income to be able to, leverage that depreciation to offset, that depreciation does carry forward or suspends indefinitely into future tax years, where maybe they'll have an opportunity to leverage the remaining depreciation that's carried over to offset passive income in a future year. Am I saying that correctly?
Yeah, absolutely. You do a cost seg study. If you can't use the deductions this year, like you said, they always carry forward. And if you're expecting taxable income in the next 3 years, it's still a good idea to consider doing it now to get it set up correctly. There's this strategy for the situation we just talked about, where you can unlock, you can basically create active deductions from real estate, and it's called the short-term rental loophole. Have you heard of that one, Jeremy?
I have heard of it, but I'd love for you to unpack it.
Yeah, so when we're talking about being a real estate professional and depreciating your rental property over 27 and a half years, residential rental property, that is, um, the way the tax code works is it defines residential rental property as properties that have a long-term stays, meaning it has to be 30 days or longer. That's your lease term. That's considered long-term rental. That falls into this category where you're supposed to depreciate those properties over 27 and a half years. And in order to meet the real estate professional rules, when you're buying those types of properties, you have this high bar of 750 hours and everything we just talked about. There's a difference, though, when it comes to short-term rental properties, and those are defined as the average length of stay is 30 days or less. Okay, the IRS puts those in the same category as hotels. Okay, and so hotels and motels, you're supposed to depreciate it over 39 years. Okay, so it's not quite as nice, but you're deemed to materially participate in that activity. It's a different set of standards, and it only requires 100 hours of material participation, much lower bar. And so what we're seeing is a lot of doctors, lawyers, software engineers investing in short-term rental properties so that they can use those paper losses from cost segregation against their quote unquote active income. So it's an interesting strategy that I think we're hearing more and more people jump on.
Yeah, no, I appreciate that. I personally have leveraged that strategy, and even with the motorhome that we own, qualifies for that short-term rental loophole, because it's treated just like an Airbnb property in the single-family space. So, we've talked a lot about the good news, but I want to talk about the bad news, and maybe the bad news isn't as bad, but I'd like for you to at least talk to us a little bit about, kind of this concept of depreciation recapture that happens at the end when the active or passive real estate investor exits or disposes of that asset.
Yeah, so the way it works when you're taking accelerated depreciation, so if you do a cost seg study and you're accelerating $50,000 of deductions into year one, you're getting to use those deductions at your ordinary tax rate, which is usually very high. The highest rate right now is 37%. And so your your tax savings is 37% times that 50 grand. Um, and when you sell the property, if you sell the property, normally you get a capital gain, and that capital gain is only the difference of the sales price versus what you purchased the property for. So if you bought a residential rental property for $200,000 and you sold it for $300,000, your capital gain, that 20%, let's say, is $100,000. That's the gain times 20%. Okay, that's your capital gain. Below that, you have to calculate a different type of gain, and that's this, call it the recapture gain. So in our example, um, if you accelerated $50,000 of depreciation, um, you're going to have to essentially get a gain of 50,000, but it's at this higher recapture tax rate, which is 37% potentially. And so that's what you're talking about. It's that recapture tax. And so what it means is that if you buy a property this year and you expect to sell it next year, fix and flip, right? Or you're leasing it out, you're depreciating it for 1 year, it generally it's not going to make sense to do cost segregation because yeah, you're going to save whatever it is, $20,000 this year. You're essentially paying that back if you expect a gain on the property, which everyone does. And so there's really no time value of money component to save. And so, yeah, you bring up a great point. If you're expecting a very short-term hold and you're selling for cash, cost segregation does not make sense. However, if you're expecting to exchange that property into a new property, that issue goes away. Okay, you can further continue to defer that recapture tax when you're exchanging.
Yeah, no, I appreciate that. And we're not going to have time for this episode to talk about what to do in that situation where you are potentially subject to a large recapture, at the time of disposition. But Gian and I both know about the 1031 exchange, strategy and why that can help, defer and continue to kick that can, down the road from a tax perspective even further. I would like to leave the last, kind of moments together, Gian, for you to talk a little bit more about, that individual investor out there that maybe owns, one or two single family homes that they rent out, in the residential space. Is there any type of an asset or portfolio of single family properties where it's just too small to do a cost segregation study? Or is this type of a strategy really open to everyone? And how might your firm be able to help support those efforts?
Yeah, for sure. Look, we're one of the biggest cost segregation companies in the country with offices from coast to coast, and we do properties that are hundreds of millions of dollars, all the way down to the millions, right? Like you can buy a $1 million property and it still makes sense to hire an engineer to go out, do a full-blown cost segregation analysis. If you asked me this question 8 or 9 years ago, Jeremy, I would say it really didn't make sense if your property value was under $1 million to go out and hire a third-party engineer like us to do it. But what we did is we launched a self-service software that people can access for smaller residential properties that are 6 units or less that have a purchase price of $1.2 million or less. Okay. And they can go onto the website, put in all the information about their property, how many bedrooms, how many bathrooms, is there, what kind of appliances came with it. Just, it's really not super complicated, but it'll walk you through the process. And for $500, they can get a cost segregation report that breaks the building down into all the things that we talked about. It's exactly what their tax preparer is going to need to report on the tax return, and it's what you can show the IRS in the event of an audit. And anyway, so we have a promo code for your listeners here if they want to try it. They can do that with with this discount code. So it's Freedom 2025, all caps. Freedom 2025, all caps. And they would go to costsegregation.com to find that software, and they'll get a 10% discount for using it for first-time listeners of your show.
Gian, that's great. And I could only imagine you guys are one of the biggest, if not the biggest in the space, if you were able to secure the URL costsegregation.com.
Yeah, we, like I said, we got into the business before most companies. We've held that domain for a long time. Um, but yeah, a lot of investors are using that platform. We've actually gone through IRS audit on that software 3 times now in great detail with the IRS, and there was zero adjustments. And that fee that we're talking about, $500 to use it, includes audit support. So we'll be there to defend it if the IRS comes knocking.
That's great. Well, I appreciate you providing that URL and also for the promo code for our listening audience. Is there maybe one or two other different ways that our listeners can connect with you to learn more about what you're up to?
Yeah, absolutely. So our website is kbkg.com, where we show all our different services. Also, I'm on LinkedIn, and I am the only Gian Pazzia in the entire world. Okay, I've tried to search for this, and there's only one of me out there. So it's Gian, G-I-A-N as in Nancy, Pazzia, P as in Peter, A-Z-Z-I-A, and I know it's going to be in the show notes. But if you search for me on LinkedIn, go ahead and ask to connect, and I'll accept that request. And I'm always posting about new tax strategies and new incentives and the changes in the tax law that impact real estate investors.
Well, that's great. Well, Gian, you are one of a kind. So we certainly appreciate you being on the show today. And listening audience, thank you again for jumping into yet another episode of The Freedom Point. I look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting.